Marcus Heck walked out of the Randolph County AASCS office on a Thursday afternoon in February 1983 with a piece of paper worth $18,000 and the particular satisfaction of a man who had just solved a problem he had been carrying since November. He drove to a gas station 2 blocks away and called his banker from the payphone. He told him the operating note would be covered. He had the PIK certificate in hand. He was reading it as he talked. He asked if the bank wanted a copy for the file. His banker said, "Yes, send it over whenever you get a chance." Marcus drove home. He told his wife the operating season was going to be all right. He set the certificate on the kitchen counter next to the coffee maker so he would remember to make a copy in the morning. He did not at that moment understand what he was holding. The winter of 1982 going into 1983 was the worst stretch Marcus Heck had seen in 18 years of farming. He was 44 years old, running a 380-acre corn and soybean operation in the central part of Randolph County, Indiana. Good ground, productive ground, the kind of flat black soil that averaged 140 bushels of corn per acre in a normal year. There had not been a normal year recently. Corn prices had collapsed from $3.65 a bushel in 1980 to $2.21 by late 1982. The operating loan Marcus carried at First Federal Agricultural in Winchester had grown each year as crop revenue failed to cover full input costs. By the time he walked into the ASCS office in February, that operating note stood at $71,400. First Federal had renewed it twice. The loan officer, a man named Aldrich, had been clear. The bank needed to see a credible plan for retiring the operating debt before the third renewal could be approved without additional collateral. Marcus had heard about the PIK program from his neighbor in November. The neighbor had enrolled early, before the full terms were announced, and was already talking about it as though the problem were solved. Marcus had gone to the ASCS office in December to get the details. The program had opened for enrollment in January. The formal name was the Payment in Kind Program. The USDA had announced it in the fall of 1982 as an emergency measure to address a specific and acute problem. The United States was sitting on the largest grain surplus in its history. The 1982 corn crop had produced record yields into a market already glutted from previous years. Government storage facilities were full. Commercial elevators in the Corn Belt were full. Grain was being stored in parking lots on the ground in improvised facilities. The price was low because there was simply too much of it, and there was no mechanism in the existing price support structure to address that surplus directly. The PIK program was designed to address it. The concept was straightforward. A farmer who enrolled in PIK agreed to idle a portion of his cropland for the 1983 season, to not plant it, not harvest it, and maintain it in an approved conservation cover. In exchange, that farmer would receive a payment, but the payment would not be a check. It would be a certificate entitling the holder to receive a quantity of grain from government-held stocks, corn, if the farmer grew corn, equivalent to the value the idled acres would have produced. The USDA already owned enormous quantities of grain. Farmers who had taken out commodity loans against previous crops and then forfeited the grain rather than repay the loans had transferred title to government storage. That grain cost money to store. Every month it sat in an elevator bin was an expense to the taxpayer and a further weight on market prices. By distributing that stored grain to participating farmers as the PIK payment, USDA accomplished two things at once. It reduced planted acreage for the coming season, and it began drawing down the surplus already in storage. Payment in kind, not a figure of speech, literally in grain. Marcus had enrolled 180 acres, just under half his corn base, in the PIK program for the 1983 season. He would idle those acres, maintain cover, and receive a certificate entitling him to collect grain equivalent to what those acres would have produced at the county's established yield history. The AISCS office calculated his entitlement at approximately 18,000 bushels of corn, based on an established yield of 100 bushels per acre on enrolled ground. The face value of the certificate was listed at $18,000. This figure was calculated by multiplying the bushel entitlement by the corn loan rate, the price at which USDA valued grain in its loan programs, which at that time was approximately $1 per bushel for program corn. Marcus looked at the certificate. He saw $18,000. He saw a document from the federal government. He had reduced his planted acreage by nearly half, which meant he had also reduced his seed, fertilizer, and fuel costs proportionally. His operating needs for the coming season were smaller, and now he had a government document worth $18,000 to put against his operating note. He called Aldrich at First Federal and told him the operating loan would be covered. What Marcus had not yet worked through, what he had not yet needed to work through, was what it actually meant to convert the certificate into money. A PIK certificate was not a promissory note. It was not a check. It was not a bank draft or a negotiable instrument in the sense that most farmers understood negotiable instruments to work. A PIK certificate was a warehouse receipt for a specific quantity of grain held in government storage. It entitled the bearer to one of two things: take physical delivery of the grain at a designated government storage location, or sell the certificate to a broker or dealer who would then take delivery and sell the grain on the open market. The second option, selling the certificate rather than taking delivery, was the path most enrolled farmers took. Very few had the storage capacity to receive 18,000 bushels of corn and hold it while waiting for a favorable market. The practical solution was to find a broker willing to purchase the certificate. Brokers purchased PIK certificates at a discount to face value. This was not arbitrary. It was the direct result of what the grain was actually worth in the market versus what the USDA loan rate said it was worth. The face value of Marcus's certificate was $18,000 calculated at the loan rate of $1 per bushel. But corn was trading at $2.21 per bushel in the commercial market. So 18,000 bushels of corn had a market value of roughly $39,780, not $18,000. The face value and the market value were different numbers because they were measuring different things. The face value measured the USDA loan rate, which was a program accounting figure, not a price. The market value measured what a bushel of corn would actually bring at a commercial elevator on any given day. The discount worked in the opposite direction from what Marcus assumed. He had heard discount and understood it to mean the certificate was worth less than face value. In the ordinary sense, a coupon at 15% off, a bond trading below par, that is exactly what a discount means. But with PIK certificates, the relationship was inverted. The face value was already below the market value of the underlying grain. A broker buying a certificate at 84 cents on the dollar of face value was paying $15,120 for an entitlement to grain worth $39,780 at market prices. The broker was not paying a discounted price for a discounted asset. The broker was paying a severely discounted price for an asset worth considerably more than its face value. This structure was not accidental. The loan rate at which PIK certificates were denominated was set by the farm program at a level designed to support borrowing, not to reflect market prices. In a year when corn was trading at $2.21, the loan rate of $1 per bushel was not a market price. It was the floor at which farmers could borrow against their grain without having to sell it. The certificate face value was therefore a floor value, not a market value. Brokers purchasing certificates were acquiring grain at well below market rates. The discount to face value was profitable for them precisely because face value was not what the grain was worth. Most farmers who received PIK certificates in the spring of 1983 understood none of this. They saw a face value. They found a broker. They accepted whatever discount the broker quoted. Marcus called a grain broker in Winchester on a Friday morning, 4 days after picking up his certificate. He told the broker he had an $18,000 PIK certificate he wanted to sell. The broker asked which elevator the certificate was tied to and what crop year. Marcus told him. The broker said he needed to check the board price on that facility. He put Marcus on hold for 2 minutes. Right now we're paying about 85 cents on face, the broker said when he came back, on $18,000. That's roughly $15,200, $15,300. Marcus asked why not full face value. The broker explained briefly. The face value was the loan rate, not the cash price. The certificate entitled the holder to grain, not to money. To convert it to money, somebody had to take the grain and sell it. His firm did that, but they needed a margin to cover handling, storage, and the risk that corn prices moved against them before the grain cleared. That margin came out of the purchase price. That's what they're trading at in Chicago. The broker added, the market is still finding itself on these certificates. It might move up a little over the next few weeks as the market gets more comfortable with the volume. Marcus thanked him and hung up. He wrote the number on the back of the broker's card and set it on the counter next to his certificate. $15,200 on a document that said $18,000. He had already told Aldrich the operating note would be covered. The difference was $2,800. He had not anticipated this 4 days earlier. The operating note at First Federal was $71,400. Marcus had planned to apply the PIK certificate proceeds against the note and reduce his outstanding balance to a level that Aldrich would renew without requiring additional collateral. The plan depended on the certificate being worth $18,000, liquid, convertible, available. He had told Aldrich exactly that. The bank had updated his file. The $2,800 discount was not a disaster on its own. His operation could absorb $15,200 toward the note rather than $18,000. The shortfall was manageable if everything else held. But when Marcus went back through the loan documents that weekend, pulling the renewal paperwork from the same strongbox where he kept his lease agreements and insurance policies, he found the language he had not focused on when signing. The operating note included a standard covenant. Under its terms, Marcus had represented to the bank that his anticipated revenue and assets for the coming season were sufficient to service the debt and meet operating costs. He had made that representation in part based on the $18,000 PIK certificate. The bank's file now reflected $18,000 as a receivable against the operating note balance. If Marcus converted the certificate at $15,200, the bank's file would show a $2,800 gap between what had been represented and what had actually arrived. Aldrich would need to know. The covenant language required notification of any material change in anticipated income. Whether $2,800 was material was a judgment call, but it was the kind of judgment call that went better when the borrower raised it first rather than letting the bank discover it during an audit. Marcus drove to First Federal on Monday morning and laid everything out for Aldrich. The certificate, the broker's quote, the $2,800 difference, the covenant question. Aldrich listened. He pulled Marcus's file. He looked at the certificate. He asked Marcus if he had considered taking grain delivery instead of selling the certificate. Marcus said he didn't have room to store 18,000 bushels. Aldrich said, "What if you didn't store all of it?" He explained, a farmer who took delivery on a PIK certificate could sell the grain directly to a commercial elevator at the market price. The same market price the broker in Winchester was using to calculate his discount. Cutting out the broker meant receiving the market price instead of 84 cents on the dollar of face value. Marcus had not thought through that option. He had assumed the certificate had to be sold as a certificate rather than converted into grain and sold as grain. They were different transactions with different economics. A PIK certificate had been designed to be used, not traded. USDA's primary goal was to get the grain out of government storage and into the market. A farmer who took delivery was doing exactly what the program intended, accepting grain, selling it, receiving market value. The secondary market in certificates was a convenience for farmers who lacked storage, but it introduced intermediaries whose margins came out of the farmer's proceeds. The ASCS office could help Marcus arrange a delivery pickup at the nearest government storage facility, a CCC contracted elevator 40 miles east in Union County. Marcus would bring the certificate, sign the delivery order, and the grain would be transferred. He could then contract immediately with a commercial buyer for the market price sale. At $2.21 per bushel on 18,000 bushels, the gross proceeds would be $39,780. After the CCC elevator handling fee and the commercial buyer's margin, Marcus would net approximately $36,800. This was substantially more than either the face value of the certificate or the broker's discount offer. Marcus sat with that number for a moment. Then he asked Aldrich why nobody had explained this to him at enrollment. Aldrich said the ASCS office handled program enrollment. How producers used their certificates was considered their own business decision. The information about delivery procedures was in the program documentation. He was not certain whether it had been highlighted at the enrollment meeting. Marcus went back to the ASCS office that week. He asked the county director about delivery procedures. The county director confirmed the process Aldrich had described. He showed Marcus the relevant section of the program handbook, page 14 of a 22-page document that Marcus had received at enrollment and filed without reading. The delivery was scheduled for the third week of March. Marcus drove to the Union County elevator with his certificate. He signed the transfer paperwork. The grain was released and immediately contracted to a commercial elevator at $2.18 per bushel, slightly below the daily spot price, which was the standard terms for a same-day contract. Net proceeds after elevator fees, $36,400. He applied $18,000 of that toward the operating note. The remainder went into his farm operating account for the 1983 input season. Aldrich updated the file. The covenant question resolved without a formal notification. Marcus had not received $18,000 from the PIK program. He had received $36,400. The certificate had not been worth $18,000. It had been worth $36,400. The face value had understated the value of the grain entitlement because the face value was calculated at the loan rate, not the market rate. He had almost sold it for $15,200. The confusion Marcus experienced in February 1983 was not unique to him. The PIK program enrolled approximately 82 million acres in its first year, the largest acreage reduction program in American agricultural history to that point. Millions of farmers received PIK certificates in the spring of 1983. The secondary market for those certificates developed rapidly and erratically. Brokers entered the market with varying terms. Elevator operators began purchasing certificates directly. The price moved daily. A significant number of enrolled farmers sold their certificates on the secondary market at a discount, either because they lacked the storage for grain delivery, because they were not aware of the delivery option, or because the immediate cash from a certificate sale was more pressing than the optimization of net proceeds. The program documentation explained the delivery mechanism. It was not hidden, but the documentation was 22 pages long and was distributed at enrollment meetings where the discussion centered on acreage requirements, cover standards, and certification procedures, not on the financial mechanics of certificate conversion. The face value on the certificate was the number that anchored most farmers' understanding of what they had. It was a government document. It said $18,000. It looked like a receivable. It was not a receivable. It was a warehouse receipt for grain. The distinction seems technical until you work through the arithmetic. At the loan rate face value, Marcus's certificate was worth $18,000. At the secondary market discount, it was worth $15,200. At the delivery and sale market price, it was worth $36,400. Three different values for the same piece of paper, depending entirely on which option the holder chose and whether they understood the options available to them. The program name had contained the answer the whole time. Payment in kind did not mean payment in currency. It did not mean payment in government support. It meant payment in the thing itself, in grain, in the actual commodity, in the physical material that the government had accumulated and needed to move. Marcus had understood payment in kind as a phrase. He had not understood it as a precise description of the transaction's mechanics. The USDA had designed the PIK program to reduce inventory, not to provide price support. That distinction shaped every term of the program: the form of the payment, the face value calculation, the delivery mechanism, the secondary market structure. Farmers who understood that PIK was an inventory reduction tool processed the certificate correctly. Farmers who understood it as a subsidy processed it as a receivable and discovered when they tried to cash it that it didn't work that way. There was no villain in Marcus Heck's situation. Aldrich had not misled him. The ASCS office had not misled him. The broker's quote of $15,200 had been accurate for the transaction Marcus was proposing. The program documentation had described the delivery option. Every piece of the mechanism was operating correctly. What had not been transmitted clearly was what the mechanism was: payment in kind. Two words. The literal meaning was the instruction.